Welcome back. Tech Mahindra has just announced its Q4 FY14 earnings, and the key, just to quickly summarize the earnings, it's a dollar revenue growth of 4.3%, significantly higher than the 2.5% that we were expecting, and more importantly, for the second quarter in a row, the dollar revenue growth of Tech Mahindra is higher than that of its peers, and it's clocking in a very strong run rate, because even in the previous quarter, the dollar revenue growth was 4.4%, and this time they've delivered 4.3%. So that is the big positive in Tech Mahindra's earnings, and that will go down well with the street. The rest of the earnings are largely in line. Rupee revenue growth at 3.3%. Margins on expected lines have declined by 200 basis points on a quarter-on-quarter basis. There was that impact of wage hike, which would have hurt them. Profits have come in at 617 crore, just a few crores, lower than the 635 crore that we were estimating, but there is an increase in the forex loss on a quarter-on-quarter basis. So overall, the margins and profits appear to be in line with street expectations, but focus on the dollar revenue. That's the key way to judge a IT company, and that has been a beat compared to street expectations and higher than its peers yet again. Ravi Menon, the VP IT of Central Broking, now joins in. Hi, Ravi, and thanks so much for joining in. Your initial reaction to Tech Mahindra's earnings?
It's positive. I think one of the key things that we would be looking out for is the revenue growth, and I think that had been the concern for many people, that Tech Mahindra would actually have soft revenue growth because of its exposure to telecom. We've been saying that that's not a real cause for concern, because they look at telecom as the segment of that space. They're a very strong player there, and they've got some transformational infrastructure services deals there. The base telecom deal in Belgium is one example. So we've been very positive on that, and I think they've delivered even ahead of what we've expected. So we were expecting, about 2.7% growth. They had to offset about 0.7% headwinds in revenue because of the restructuring fee, from British Telecom. That amortization has gone off this quarter. It's only partially there, so about roughly 6 million or so was a headwind from that. So despite that, this is very commendable growth. So we think that's positive. I'm a little puzzled by what's the miss in the path. So we actually weren't expecting this much of a forex loss, and maybe the other income is also a little lower. So I'd get into the details of that and see. Headcount additions actually come in ahead of what we thought. So that's also another positive. It looks like they're going to ramp up.
Okay, so overall, what kind of a reaction do you expect for the stock tomorrow? Could it open up 2% higher, 3% higher? What's your estimate based on this?
I think it should definitely go up higher, like maybe even 3 to 4%. That's possible. This is, the best results. I'm not talking about the path line. I expected that we would find what it's costed, and it shouldn't be something that's alarming. But, with that disclaimer there, people are looking mostly at the revenue and the margins. It should be fine. This is the best results for the season for an IT services firm, I think.
Okay, one of the things that could have hurt them is provision for taxes has actually gone up. It's 209 crore versus about 26 crore on a quarter-on-quarter basis. So that is one of the things perhaps which is there in the P&L. But Ravi, overall for FY14, they've closed the year with a dollar revenue growth of close to about 17.7%. Now that's a good 150 basis points higher than what I think TCS had wrapped up the year. That was, I think, about 16.2%, if my memory serves me right. This kind of growth rate, if it sustains for Tech Mahindra, do you think the street is now going to re-rate it and assign it a higher PE?
We've actually argued for a re-rating for some time. We've assigned a 14 times multiple, 1 year 14 ahead, 14 times multiple to other tier 1 players, Wipro, HCL Tech, and Infosys, and 17 times to TCS. And Tech Mahindra, it's been trading at about between 11 and 12 times, and we've been arguing for a 13 times multiple for that. I think that it's likely to happen. And one more thing that had been concerning people is how much will this restructuring fee, when that goes away, how much will that hurt margins? So, since it hasn't affected it much, I think that would be definitely a positive. That overhang's gone away. And now I think if they improve the cash conversion ratio too, that's another metric that people have been concerned about. If that's also improved, I think we can definitely look at a re-rating.
Okay, but it's been 2 consecutive quarters, which have been extremely strong. So would the skeptics now be quiet, or do you think they would still require more proof? Can the re-rating happen perhaps, with this quarter, with the end of this quarter, with this set of earnings?
Like I said, the second part is also crucial, that the cash flow conversion.
Okay.
I haven't taken a look at that yet.
Sure.
Yeah, so once if that's good, then I think definitely.
Okay, Ravi, appreciate you giving us your perspective. Ankit Pandey of Quant Broking as well joins in. Hi, Ankit, your initial reaction to Tech Mahindra, and according to you, does it warrant a change in any of the expectations or your estimates on earnings or, for the next year?
Hi. Well, I think the results are pretty positive. I think they've delivered over 4% growth in sequential terms for 3 consecutive quarters now. So momentum is with them. They have been seeing a lot of ramp-ups in the telecom vertical over the last year or so. And also in the enterprise segment, that's formerly certain, they've been recording some good deal wins, and they've been seeing severe ramp-ups. That has also helped them maintain their margins. So that's played out exactly as we expected, about 200 basis points hit on the margin line this quarter, with wage hikes coming in and with the BT amortization of $6 million going away. So all that has contributed to the impact this quarter. But on a full year basis, they've delivered an 80 basis point improvement in margin. They have delivered on an organic terms 12.2% growth in dollar revenue. So all that tells us that the company is on a good growth path. They've been seeing healthy ramp-ups. They are able to absorb the initial costs of these ramp-ups and also integrate some of the acquisitions they've had through FY13, through FY14, Complex IT, the likes of Cowviva and HCS also now fully absorbed. So they are on a sustainable growth path. Margins also for us are likely to expand further. They have little headroom in utilization, we think not much. But definitely when we look at something like SG&A as percentage of revenues, just clocking at about 16% for the full year. There's also room to gradually taper as the company continues to grow with these large deals and with telecom deals expanding as we go on. So really 3.5% CAGR, I think that looks doable for this company, and I think that's pretty good. Obviously the overhang for the company is still the $200 million gap in its balance sheet, which is amount pending investigation. That still needs to be resolved, so there's still some overhang, you can say, of the sector. But they have, obviously, last quarter they did indicate that the Indian litigations are by and large settled, and only the international ones remain. So cash balance is about $600 million. We're looking at $200 million amount pending investigation. So there are some cautious comments that I would like to highlight there. But by and large, the company is on a good growth path. We do assign them 12x forward earnings, and we do think that this has chances of a re-rating. Right now, it is trading at 12.5, 13 times forward earnings.
Okay, Ankit, thanks so much for giving us your perspective on Tech Mahindra. But Asian